So you've chosen your investment strategy and you identified a market where you want to invest. Now is the time to start getting your financial house in order to make sure that when you actually identify a property, you're going to be in the best possible position to pull the trigger on it. I'm James Masotti. I'm a real estate investor, the owner of Our Team Accounting and Crystal Clear Property Management. On this channel, I'm passionate about helping business owners achieve their personal and professional goals through intentional financial planning. So let's go ahead and dive right into today's video. So the very first thing that you're probably not going to be surprised by is needing to make sure that your credit is in order. Now, generally speaking, if your credit's at least a 620 or higher, you're going to be okay. But realistically, we want to be in that 680 to 720 range, and 720 and higher, definitely 780 to 800 is like your best possible scenario. And so if you're in the lower end of that range, don't worry, there are some options for you. So one, you will be able to find some lenders that may have some flexibility depending on the reason why your credit score is as low as it is. If you had something like a divorce or something along those lines that maybe is what reduced your score, or it's a bankruptcy that isn't completely off your record yet, but you're 5 or 6 years into that, and you've otherwise had a really great, stretch, you might find some lenders that are going to be able to be more flexible with you. However, if you're regularly missing paying your bills, if you are not good with budgeting in your own personal life, then you really want to make sure you're getting this in order, because taking on an investment property, it's a significant thing to juggle, especially when you're considering just all the implications of cash flows and wanting to make sure that you don't mess it up and then put yourself at even bigger financial risk. The next piece that you're going to want to make sure that you understand when you know that your credit score is in a good position are these two key financial debt ratios that lenders are going to be looking at. The first one is what's called the debt to income ratio. And the debt to income ratio is basically going to, when they pull your credit report, they're going to be able to calculate up what are the monthly payments for all of your loan obligations. They may also ask you for things like, do you owe any child support or alimony payments in addition to those things? And then they're going to compare that to your monthly income. And there's going to be a ratio that every lender is going to be comfortable with in terms of, do you actually have enough discretionary income to support the investment that you're going to make? Now, as real estate investors, because we're not just buying a second home or a vacation home, we're actually buying a cash flowing rental property. And so there's going to be income from that property that's going to actually help pay for the mortgage. The other ratio that lenders are really going to be looking at is what's known as the debt service coverage ratio, or DSCR for short. And the debt service coverage ratio is represented basically by looking at whatever the monthly income is. We'll use some easy math of saying $1,200 a month. And as long as all of the projected expenses plus the principal and interest payment on your mortgage are less than $1,000, then that means you have a debt coverage ratio of 1.2, or 120%. Your rents are 120% of your total expenses. Now, most lenders are going to want a DSCR somewhere between 1.2 and 1.5. Although in some markets, when things are really, lending is really loose and very competitive, I have seen numbers go down as low as like 1.15. Now, part of the reason why they might be willing to go down to 1.15 on a specific property is also because as you start to grow and expand your portfolio, there's also what's known as a global DSCR number. And that global DSCR number is really representative of, this idea that lenders don't really want to put themselves at a potential risk by looking at one property that might have a fantastic debt service coverage, but you're buying that and you're putting it into a portfolio that is otherwise struggling to cover its debt obligations. And in that scenario, they may still not be willing to lend on that asset because your overall DSCR is not fantastic. The flip side of that, though, is if you have a portfolio that has really great global DSCR, you may have some flexibility for them to drop their DSCR numbers on that particular property because they know it's going into a portfolio that can better absorb things, especially if you have a lot of equity in the property and it just doesn't necessarily have as strong of cash flow. That's where, again, the lender that you're working with is dramatically going to influence their flexibility on those numbers. But understanding how to calculate those two key metrics is going to be really important for you to be able to understand what banks are going to be looking at when making lending decisions. The next thing that we want to make sure that we're thinking about as we're getting ready to dive into this world of, real estate investing is making sure that you've got your emergency reserves set aside. Now, everybody kind of hears this anecdote of the proverbial 2 a.m. phone call because you have to fix somebody's toilet and all of that sort of stuff. And in reality, it almost never happens at 2 a.m. But what could happen is, again, we've got this list of, capital expenditures here that are going to happen at some point, and you never know when they're going to happen. So you might buy the property today and you've done your inspections and everything looks great. Doesn't mean that something's not going to break a month from now or 2 months from now. And now all of a sudden you've got a significant bill that you're going to have to pay. Now, yes, we are going to be saving and accumulating some of those expenditures and capital and repair costs over time, but you still want to make sure that you have enough safety net there to be able to do that. So when you're starting out, I recommend trying to set that at least somewhere in the 3 to 6 months range. But really, again, understanding that these expenses, when they pop up, it's not an easy percentage of your rent. So again, if you got $1,000 a month rent, and you're only saving up 6 months, like $6,000, that could go really fast if you needed a $15,000 roof, right? And again, you're not keeping all 6,000 of that because you still have to pay your mortgage and your interest and your insurance and your property management fees and all of those other things. So it's not just that 6 months of that. It's really you're only putting in, $600 over the course of 6 months, right? So you really want to make sure that you've got enough cash set aside that you can weather storms, from an initial hit if actually one came through, and have those extra funds set aside. If you're interested in raising capital from investors, then go ahead and scan this QR code right here to access the template that I use to get my first couple of investors. Investors are always going to be concerned about how you're going to preserve their capital and return it to them. And yes, they want to know about what their returns are going to be, but at the end of the day, as long as it's not some crazy number or way below the market, they're far more interested in learning about you, your character, your quality, and how you're going to protect their capital. So click the description below or scan the QR code to check out that download. So now that we make sure we've got enough cash set aside for emergency reserves, the one that's probably going to be more obvious to folks is the down payment. Now, your down payment is going to, vary from anywhere from 3.5% if you're going to be doing house hacking and you're using an FHA mortgage, all the way up to closer to 30% if you're going to be buying a commercial property on a commercial loan. So that is kind of the range of things that you're going to be saving up. So obviously, depending on your market and whether you're buying a $100,000 property or a $5 million property is dramatically going to change how much money that you need to have saved up. Another thing to really be aware of when you're talking about down payment money is that a lot of lenders require the down payment funds to be what's called seasoned. And seasoned for most lenders basically is that the money has to be sitting in your account for at least 60 days. Some banks might be 30, some days 45. Again, the point is check with your lenders, make sure you know what the seasoning requirements are. And the reason that they have these seasoning requirements is they want to make sure that it's either your money or that if you receive the money as a gift, that gift has been documented, that the person's not expecting to get the money back. And the reason is because they've already pulled your credit reports and they've already been doing their analysis on the debt to income and debt service coverage ratios. And so, what they want to make sure of is that these aren't funds that you've basically borrowed from somewhere else, and that, has additional debt obligations on top of it that have not yet been reported to one of the credit bureaus for them to know to be calculating that in those debt ratios that they're evaluating. So understanding how much you need to have saved up and how long you need to have those funds seasoned for is really important to understand. Now, if you've gotten to this point and you realize that hey, I don't have that much money, what can I do? There are a couple of options that are still available to you. So you do have the ability, for example, if you're using a commercial mortgage, you could go the hard money route. And hard money lenders will a lot of times lend money at a higher percentage of the purchase price or the total project cost, especially if there's rehab work that is involved with it. But they may still have a down payment requirement, and that often changes with your experience level. Then you also have, for example, the opportunity to bring in a partner. So that's another option. If you don't have the funds or you don't have the credit score, you could bring in a partner who has good credit or who has the funds. And so you can still get into real estate by leveraging somebody else and their position and things along those lines. As you're getting your finances in order, we're going to start talking about the topic of the difference between buying property in your personal name and buying property in business name. And while this is a topic that goes and covers topics beyond just the finance aspect of things, we're going to keep the conversation specific to that for right now. And the reason for that is when you are going to be buying in your personal name, you're more likely going to be able to get 30-year amortization and 30-year term, along with a fixed interest rate that's usually lower than what you're going to get with commercial lending. But you're also potentially going to be dealing with banks that are having their loans backed by Fannie Mae and Freddie Mac, which means that there's probably a 10 property limit per person. So quick little tip here, if you buy in your name and then you have a spouse or a business partner that you're buying with, you can each get 10 and you can double the number of properties that you're able to buy. However, you want to make sure that you're aware of how you're going about doing that. On the flip side, if you buy in the business's name, you have other legal protections and things along those lines that come with it, but you're also more likely going to be looking at variable interest rates, higher interest rates. You may still have to be signing a personal guarantee on the real estate. You're going to be looking at separate loan and amortization terms that are oftentimes shorter than normal, but you're also going to have a lot more flexibility in terms of size of loans, how many loans that you can have, and things along those lines, because most of those banks are going to be keeping those loans on their balance sheets, and they don't have the backing of those government entities, Fannie Mae and Freddie Mac, to backstop those loans. And that's also why they oftentimes will have higher down payment requirements than ones that you're going to be buying in your personal name. So again, understanding from a finance perspective which way you're going to be going will also impact the types of lenders that you're going to be reaching out to, and whether you're going to be reaching out to a residential mortgage person, or whether you're going to be reaching out to a commercial loan person. Because even if you're buying an investment property, if you're buying it under your own name, then you're still covered under consumer protection laws. And so that for banking regulations means that you're going to be dealing with a residential banker, a residential loan person versus the business or commercial loan department, which again are going to be different teams with different requirements, different underwriting, all of that sort of stuff. So important to understand and determine at this point in your journey. And a quick little bonus tip here is, while not necessarily required at this point, one of the things that I really recommend to folks is that whether you're buying in your personal name or in your business, that you make sure that you get a separate bank account set up. And so especially if you're buying in your personal name, it may be feel easy to kind of have it all mixed in with your own personal finances and things along those lines. But the reason you really want to make sure you have that money, again, separated, is you want to make sure the rent's coming in there, that all of your expenses are getting paid out of there, and that you potentially even have a second bank account where you're saving up what that like accrual balance and things along those lines, that those funds that you're saving up for those future capital and repair costs that eventually are going to happen. Some states may require you to set your security deposits in separate bank accounts. And so I really do recommend that, so that that money doesn't come into that same bank account that you have. And then you run the risk of accidentally buying that brand new bowling ball or pair of running shoes that you really wanted. And so this is even doubly true if you're going to be buying or decided that you're going to move forward, setting your acquisitions up in a business name. You want to make sure that you have separate business bank accounts set up, and that you're not running those business expenses through your personal account, because not only does it make it difficult to kind of manage the money and keep things set aside and keep your reserve accounts in place, but you also run the risk of creating legal exposure for yourself that it really defeats a lot of the purpose of setting up those separate business entities in the first place. So just again, kind of a little bonus tip, things to be thinking about as you are going forward and getting ready to make those investments. And so now that you've got your finances all in order, we're going to start talking about how you can actually get loans on your properties and some of the creative ways that you can go about approaching structuring your loans if you don't feel like you meet like the traditional buy box and stuff along those lines. So go ahead and click the link over here and I will see you in the video.